Good afternoon. This is Duane Lowry for the DPP Grain Desk on Sunday, April 22nd. The outlook here tonight is going to be based on a few different things. I don't see anything here that stands out as being bullish, whether it's new bullish or old bullish, or I don't think you see anything that should suggest upside direction tonight based on price action from Friday. Weather outlook here, weekend rains were good, but maybe a little bit better than expected. The outlook for this week should be mostly conducive to planning and fieldwork activities for most areas during much of the week. The 6 to 15 day period shows a warming trend again. I don't see anything threatening about the forecast from any aspect through at least the next 2 weeks, and the overall pattern looks, favorable for planning and early crop development. So I think the weather's probably a negative influence, but not necessarily different than what we had on Friday. Global weather, I don't see anything very concerning, and most areas have been possible concern points in the last week. Forecast looks better here to start this week out than we had maybe on Friday or some of the days last week. But so weather is a bearish item. Price action is going to depend whether you want to focus on beans or you want to focus on corn. In the case of corn and wheat, wheat's been steadily declining. Fundamental factors there are bearish, have been, and look to remain that way until we can find a northern hemisphere wheat production problem, which doesn't exist at the present time. Wheat continues to be priced competitive against corn. Looks like that could continue to be the case, and if it's not going to be the case, it's going to be due to the fact that corn prices are going to get weaker than wheat. And that's going to happen if and when the market begins to get more confident about a new crop production scenario that points to a significant increase in carryout. Certainly is a possibility. We all know it's a possibility, but it's just way too early in the year to be confident in it. That said, take a look at what price action has done. For all practical purposes, the corn trade has been bullish for months, and here we are at the bottom of a 13-month trading window. Price parameters of the last 13 months. We're at the bottom of price parameters for the last 4 or 5 months. We have a situation here where the market's been trying to be bullish on Chinese demand multiple times in the last 4 or 5 months. Each time it's met with a failure and a disappointing reaction to prices. Friday was a great example. We had all kinds of rumors rampant that China was going to be buying corn or was buying corn, did buy corn. I certainly think that a lot of the factors in the rumors are true, but yet the market opened higher, made the highs early, and quickly fell hard and closed very poorly and finished at the bottom end of the parameters for the week. So we're going to come in here tonight, probably look at starting a little bit lower, but out of respect for maybe somewhat oversold conditions and already being down quite hard, and traders expecting USDA to offer an announcement of just exactly what kind of corn quantities and delivery periods were sold to China late last week. Those traders will be expecting those announcements tomorrow morning, Monday morning. Out of respect for that, you may see some limited weakness in corn tonight. Maybe the same situation in wheat, limited on ideas that a lot of this bearishness is already known. But you still have a situation here where the market is clearly liquidating. We have large speculative long positions in the corn market, still have. Some have been liquidated, of course, but the market is trapped with long positions. It's trapped with a wrong thinking mentality, and the focus has shifted from tight old crop supplies to possibly burdensome, plentiful new crop supplies, and that's where the focus is, and that's what's driving market direction. New crop corn prices, from a producer standpoint, may not be favorable, may not be super attractive, but when you look at where they could be headed, both in the next 60 days due to favorable weather and lack of a weather threat and timely planning, and when you look at where they might be headed in the fall, based on changing fundamental dynamics, 530 to 550 December futures might still be a very attractive sale, and may have very limited, upside potential from current levels. And I think when producers are making new crop marketing decisions, it doesn't matter what price levels have been missed in terms of missed selling opportunities. It doesn't matter what price peaks you've seen in the last few years. All that matters is how does today's price offered compare to what you might be facing for selling opportunities in the next 5 or 6 months or beyond. And I think when you look at it from that perspective and you look at a little bit of history for guidance, all of a sudden this 530 to 550 level that's currently offered for new crop futures might still be a very attractive sale. As far as beans are concerned, Friday had a big up day, completely opposite of wheat and corn. A lot of rumors around that Brazil was going to do something to halt or slow soybean exports due to limited supply. Really doesn't make a lot of sense that they would do such a thing, nor is there much for precedence of them doing such a thing, despite the fact that crop sizes continue to, or crop size projections continue to deteriorate slightly. So I think that the market got blown up on probably a lot of strange and unfounded rumors, and I think that Friday afternoon, Brazilian officials, both from government officials and private sector, came out to totally dispel those rumors, and I don't think there's anything to it. That being said, the late strength Friday did chase some shorts out, and make no mistake, in the last several days there's been a fair amount of people looking to try to pick a top here in beans for all legitimate reasons. A lot of those would have been blown out with Friday's trade, so the market is relatively clean. You actually had, in the May option expiration, had a lot of out-of-the-money calls exercised in the May, probably due to how the market finished in the last few minutes of Friday. Those are positions that are going to most likely be underwater immediately on the opening tonight. You've got a situation where the bean market is very vulnerable to some significant liquidation pressures at any time, and I don't think there was anything about Friday's price action that takes away that risk. In terms of new crop beans, we're definitely buying acres from where we were on March 30th ideas. We're definitely setting the stage to maximize double crop acreage potential for beans, and we're also making some final last minute changes, switches from corn acre intentions to soybean acreage. That's coming about from a couple of standpoints. Number one, corn prices are declining. Number two, producers are understanding, embracing, and respecting the chance that corn prices will continue to decline with a favorable crop in 2012. And the new crop soybean prices have been going up, and the producers now have an opportunity to lock in some pretty good profits with new crop prices. And I think the combination of all those factors will find final soybean acreage at least 2 million higher than the March estimates, maybe up to 4 million. It would not be an unreasonable possibility. And I think the supporting the need to support new crop bean prices from this point on, it quickly is going to diminish as the planning decisions are finalized and the planning season basically becomes quickly comes to an end here in the next few to several weeks. So the incentive to keep prices up here will diminish. Now there may be an incentive to try to maximize South American production. I think that's certainly is a legitimate storyline, but that's still some time away, and that's not the most immediate concern. So Friday's blow up in prices due to an unfounded rumor that was seems to be solidly denied by Friday afternoon should help to weigh on the soybean market and give back some of Friday's gains at least. And I think that over the next few to several weeks, you got potential for soybeans to erode by a significant amount due to liquidation pressures. So the bottom line here is tonight, producers need to continue to look at corn for new crop marketing opportunities, not look at new crop corn prices in relationship to price peaks we've seen in the last few years, but look at it in relationship to what downside risk is. And from 530 to 550 December futures, to say your downside risk could be 50 to 75 cents by the 1st of June is not an unreasonable statement. To say that it could be $1 or more risk from these levels by the time we get to harvest is not an unreasonable risk. And I think when you start talking about producer marketing decisions on new crop corn, you got to look at it from that perspective. When you look at producer marketing decisions on new crop soybeans, I think you take a big picture look and you say that global wheat and U.S. wheat prices and supplies are plentiful, and that we are no longer at extremely high prices there. We are on the pathway to not be at extremely high prices on corn either, and that makes the sustainability of $13, $14 soybeans and $13.50 new crop futures now seem to be maybe a little more difficult to sustain without some sort of a weather problem this summer. And I think that producers need to look at their marketing decisions from a standpoint of trying to protect profits, forget about trying to view current prices in relationship to recent years' highs. For the DPP Grain Desk, this has been Duane Lowry. Thank you.